All right, let's dive right into this explainer. Today, we're unpacking a massive, kind of mind-bending macroeconomic mystery based on some really thorough recent research. The big question is, why aren't massive investments in human capital translating into actual economic growth in China? If you've ever wondered why pouring endless resources into education doesn't just automatically equal an economic boom, well, you are definitely in the right place. We're going to break down the data and frameworks straight from the source to see exactly where the economic engine is stalling out. Okay, so take a look at this staggering figure, 1.5 billion college graduates. Actually, scratch that. That's a slight translation quirk from our source material. It really means 150 million. But honestly, the sheer scale here is wild either way. Since the massive expansion of higher education back in 1999, the system has effectively produced the largest talent pool in human history. Theoretically, right, this explosive accumulation of knowledge should be the ultimate economic engine. That is a lot of brain power. And that brings us to the core mystery of the entire thesis. We've got record high education levels, so where is the economic boom? It's a really profound disconnect. A highly educated workforce is supposed to naturally elevate something called total factor productivity. But the data, it shows the exact opposite. The degrees are definitely there, but the output just isn't. So we have to ask, where exactly is the friction happening? This starkly illustrates the paradox we're looking at. You'd think more degrees means more innovation, right? But despite the explosive growth in graduates, total factor productivity, or TFP, which basically measures how efficiently and innovatively an economy uses its people and capital, has actually tanked. It plunged from around 4 to 5% down to a totally stagnant 1 to 2% since 2008. When growth drops while the number of educated workers absolutely skyrockets, we are looking at what researchers call a high input, low output trap. To wrap our heads around the education side of this paradox, the thesis brings up something called screening theory. Basically, we're seeing massive overeducation. Because there are just so many graduates out there, a degree completely loses its intrinsic value as a measure of actual capability. It just becomes a baseline signal, a way to clear HR filters. High-skilled talent ends up wasting away in mismatched, low-skilled jobs. Imagine having to get a master's degree just to land a basic admin job that realistically only requires a high school diploma. It sparks a credentialing arms race, and honestly, it's just massive systemic waste. Moving into part one of the investigation, we're looking at 4 specific institutional pathways. Pathway number 1 is the M2 money supply expansion. Think of this as creating a massive wealth illusion that aggressively outpaces actual disposable income. Just look at the numbers from 2020 to 2023. The money supply grew at roughly 9.5%, mostly flowing straight into real estate. Meanwhile, everyday disposable income grew at only half that rate. It's literally like watching your rent skyrocket while your paycheck barely moves an inch. Because of this, families simply have less real purchasing power to invest back into the next generation. Then we have pathway 2, indirect tax dominance. We're talking about things like VAT or consumption taxes, those sneaky fees hidden right in the price of everyday goods. Here, they make up more than 60% of total tax revenue. This acts as an invisible budget squeeze. It passes the burden directly onto consumers and artificially suppresses overall household consumption to under 40% of GDP. When family budgets are squeezed this tight, their capacity to invest in raising future innovators just plummets. Which brings us to the third pathway, and honestly, this number just blows me away. 3 million. That is the sheer volume of people who applied for the National Civil Service exam in 2024 alone. The thesis identifies this as more than just a sudden passion for public service. It's a massive, systemic avoidance of risk. Because the private sector is facing higher costs and so much uncertainty, all that top talent is desperately seeking the ultimate stability of a government job. And this gives us what researchers call a safe haven effect. The contrast here is just jarring. You've got an average 60-to-1 competition ratio just to get a civil service role. Meanwhile, private sector hiring, which is supposed to be the actual engine driving technological innovation, has dropped 15 to 20% compared to pre-pandemic levels. The private market is literally being hollowed out. And that sets up pathway 4 perfectly, the crowding out effect. You see, the public sector isn't just hiring standard administrators. It's actually acting like a giant siphon, absorbing the exact scientific and tech innovators needed to drive market efficiency. The thesis argues that as the public sector expands, it disproportionately pulls these brilliant minds into non-productive administrative roles. When your absolute best engineers are pushing paper just because it's a safer bet than joining a startup, your overall economic innovation is going to flatline. Okay, let's jump into part 2, the hard proof, looking at the empirical panel data. To prove this isn't just theory, the author rigorously tests these pathways using a massive data set. We're talking a full decade of data across 31 different provinces. By using a really robust methodology called a two-way fixed effects model, the researchers essentially filtered out all the unique regional quirks and global economic noise. What this leaves us with is a highly impartial, statistically sound look at how these specific institutional constraints actually impact productivity on the ground. And the results? Well, the regression analysis isolates a highly significant finding. The generalized tax burden acts like a massive anchor, aggressively suppressing TFP growth. Notice the coefficient highlighted there is negative 0.013. In plain English, that means for every 1% increase in the broad tax burden, total factor productivity drops by 1.3%. Extracting all those resources away from the private market acts as a heavy, highly measurable drag on overall economic efficiency. But here's where it gets really fascinating. The data uncovers this strict 5-year delayed lag when it comes to demographic shifts. When you look at the aging rate, so the percentage of the population over 65, the negative impact on productivity isn't instant. It has a gestation period. But at exactly the 5-year mark, boom, the damage materializes and becomes statistically significant. This lag is a massive red flag, folks, because it means the economic friction we're about to experience is already completely baked into the demographics of the last half-decade. This brings us to part 3, a systemic future warning. Here's where the author issues a pretty stark warning based on the findings. You have to remember, all this empirical data, it came from the relatively mild 2008 to 2017 window. That was before the most extreme spikes in civil service fever and before population growth officially went negative. So, these alarming efficiency losses we just looked at, they represent just a baseline. They are a conservative lower bound. The negative impacts we just tracked are highly likely the best-case scenario compared to what's happening today. And that leaves us with this final, provocative question to chew on. If that was just the mild period, what happens as these institutional constraints tighten even further and the population ages faster? How profound will the true loss of human capital become? The talent is absolutely there, but until the structural misallocations, the extreme risk aversions, the invisible taxes, the public sector siphoning are resolved, that historic investment in human capital will just remain trapped. It's a sobering look at the true mechanics of macroeconomic growth, and frankly, a massive challenge for the years ahead.